Hello traders, it's Samurai Trader here. Welcome to this Q&A session where I'll be answering a number of questions from members. If you'd like to go to full screen, bottom right hand corner, click on that, and of course you'll be able to look at the slides a little easier. Understanding the risk, you're all members watching this, so of course you hear me go through this particular disclaimer every session, so please, if you haven't read it for a period of time, please ensure that you do. So let's start off with this particular slide here. If you do what you've always done, you'll always get what you've always gotten, by Tony Robbins. And I don't think he came up with that phrase. It's been around for many years. Gee, I'm probably showing my age here. But it's very true, traders. We have hundreds of members around the world now. We're actually I think globally now we're well over the 1200 mark, 1200 members globally, and we're growing. And so I get to see the good, the bad, and the ugly side of trading, from my own trading, from people that I work very closely with, from the industry, and of course from members. And one of the greatest challenges I still have in working with traders is being over leveraged, that is risking too much per trade. Traders, if you don't have the right trading account at this stage, hold off until you do. Remember, even if you're in your 50s or your 60s, you've probably got at least another 20 years of trading ahead of you. So it's very important that you have the right risk amount. And this really leads me into one of the questions from one of our members, and he asked about trading futures, and this is from Terry in Australia. So one of the greatest challenges, of course, we've seen, and Terry up till now, by the way, has been trading Forex. Just this week alone, of course, we saw the CFTC kick and the NFA, of course, kick FXCM out of the USA market. And you've probably heard me talk about for a long time that I've always believed that FXCM is a market maker. Now, by the way, one thing, and because I've been involved in the industry a long time, I'll quickly tell, I hope I don't lose anyone here, but I want to quickly tell you about this. Every broker has what we call an A and a B book, and one of the reasons why many brokers will run their own book, particularly with mini and micro accounts, if you're running a mini or a micro account, you can't put out there with the liquidity providers a $10,000 trade. So what they'll do is they'll put all these trades together, and they'll quite often run an A and B book, and one of those books they'll hedge or they'll run themselves, or they'll take the losses or the gains on that book. Now personally, I believe this is one of the reasons why FXCM got so badly hit with the debacle with the Swiss collapse, where we saw they lost, what was it, I think 235 million or whatever it was, and they had to borrow 300 million to bail them out. And I've never seen that officially anywhere, but that's my belief. So if you're the broker and they say they offer straight through processing or no dealing desk, well, one of the challenges is, if ever you're talking to one of their dealers, or I should say one of their sales reps, is, well, how do you handle minis and micro accounts if you're not a dealing desk? Because you can't put that straight out in the market. They've got to put all those together in a basket, if you like. So anyway, just something to think about. But it leads us into one of the greatest challenges, of course, in trading Forex, is the spread. Now in the United States now, we're now really down to Gain Capital, which they own FOREX.com, of course. After the collapse there of FXCM, they're now one of the world's largest brokers. And what is it, Ananda, is that how you pronounce it? Of course, they're over there, and we see Thinkorswim and some others, and there's a few IBs introducing brokers over there that are connected, but there's very little competition in the United States now for brokers, which I wouldn't be surprised if we saw some of the margins go up. But on the other hand, we're seeing thousands of traders getting out of trading Forex just because of stops being run, spikes, a whole lot of things there. Now we're seeing the regulators around the world really coming down on this. One of the great challenges now with FXM, because they're still in existence, and let's remember that they are a NASDAQ listed organization, is that the regulators, ASIC in Australia, and of course the UK regulators, will all now be looking very, very closely at what we call deceptive and misleading conduct, because the biggest thing they've got FXM on is that they said they had no dealing desk, and of course they were betting against their own clients' trades, or taking trades against. And of course they had tens of millions of dollars in profits they made out of that. So the regulators in other countries, if they haven't already raided the offices of FXM, I can't see, I don't think it'll be long, because I know with ASIC and the regulators in the UK, they're very, very strict on that. So long story short is, with Forex trading now, it's becoming a fairer market, but there's still some things happening. And if you're trading a $10,000 account or a standard lot and you have 10,000, let's remember, if you're, and you've heard me talk about this before, if you've got a 2 to 3 pip spread, that's $20 to $30. That is a commission. That is what the banks and the brokers are earning. You might pay a 0.3 to the bank for what we call the liquidity provider, but it's still very, very expensive. And in a paper that Bart put to us back in December, where when he analyzed his own trading, it was 15% in commissions when day trading Forex, compared to 4.82% with futures. So it's something to really think about. Now, for all our, we have a lot of Forex traders that are members with us. One great thing about Forex, of course, you can start off by trading mini and micro lots. You can cut your teeth on that market and then progress to trading futures, which leads me into something where we probably have a good 90% of our members are futures traders, but I'm still seeing, long story short, I've been talking for 6 minutes now, the risk factor. Traders, even though your broker may offer you low day trading margins, you hear me talk about the 2% rule as a max. I trade at a 0.5% level. Now that's not realistic for most traders, and I'll explain why. So let's take CL. I'm trading CL at the moment, and I've just got off from doing a one-to-one client I've got doing a coaching session. We were just talking about this. So if your average stop loss with CL is 10 ticks, now that's $100. If you're going to stick to the 2% rule, that means, and let's forget about your brokerage, your commissions for a moment, but you're looking at what's 2%? $100 stop. What do you need? You need a $5,000 account. So if you have a loss, you're down 2%. Now this is one of the advantages with Forex. Of course, if you're trading a standard lot, your account drops, you can start trading minis, so you can drop down your leverage. So there are some benefits if you can get with the right broker. Now, by the way, I can't tell you who the right broker is on that. You really need to do your homework. Make sure they're regulated, and wherever possible, go with they've got to really, in my opinion, be it's better off paying a commission and straight through processing, no dealing desk. I think that's really important. But back to this, a maximum of 2%, which means you need $5,000. Now when you start to build your account and you're able to say drop down to 1% or even 0.5%, I'm able to add to a position up to 4 times without being exposed any more than 2%, which means that I might say enter a trade, have a pullback, then it turns around and starts heading back in the trend direction, into the trade direction, and I get another setup, I've got another indication to enter the market again. Let me get this on. You can probably tell it's I'm a little tired. It's 4:39 in the afternoon. I've been up since 2 this morning. Anyway, I get another entry, and I can add again to a position. I can do this up to 4 times, and of course we are momentum traders, and so if I've got momentum, I will do that. And that's the other important thing, traders. I'm not great at trading ranges at all. I am a momentum trader. I want to see the market move. In actual fact, John Shirley, I think, hit the nail on the head recently, where he said if the market hasn't moved within 5 candles, it's time to get out. Something may have changed, and I say a similar thing. Something may have changed. It's better to get out, maybe lose 1 or 2 ticks, or a couple of pips, you can always re-enter. Something for you to think about. But back on the risk, so please be very careful on the day trading margins that are being offered traders, because if you say open a CL account with say only $2,000 and you then lose $100, what's that? How much have you lost? What's that? 5-6%. So 5% I think it comes out to. So that is devastating, not only to your account but to you from a psychological point of view. I want you to really think long-term when it comes to trading. This is very important. Now this now leads us into another important point, is buying right. Now times traders will say to me, why do I use indicators? Well, if you look at the T25, which is simply a 2 to 5 candle pullback and a reversal and back in the direction of the trend. Now I like to see a close on or under the 8 EMA, under what I call the trigger line, because that works for me. And someone had a go at me the other day because one of my videos I've got in there how to trade without indicators, but they said, look, you're using moving averages. Okay, all right, moving averages may be an indicator, but I'm using them for trend direction, and T25 is nothing else but really the candle formation and the momentum behind it. But indicators can just basically give you an added confirmation, even though it may get you, or they may get you in at a slightly later time period. Okay, so now of course a trade entry is not as important when you're swing trading, when you've got of course a much larger target. Now I know of course when we're day trading we're effectively almost scalping the market, so your entries are important, but to pay perhaps an extra tick on the basis of something confirming, if that works for you or it works for me, okay, I'm willing to do it. Of course we have pure price action traders. If that works for you, whatever works. But the point here with Jesse Livermore, it isn't as important to buy as cheap as compared to at the right time. And you've heard me make this little quote. The first gee, what is it? Oh, look, how's that? I've even forgotten. It's about the second mouse always gets the cheese. Okay, let me say that again. The second mouse always gets the cheese. Sometimes getting in first isn't always the best, but then there's lots of traders that will jump in, they'll test the market, they'll buy a few contracts, and then they'll get out, or if the market starts to move, they'll add that to their position. Leading into the next thing that comes up. After spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this: it was never my thinking that made the big money for me, it was always my setting. And this comes down to a question that was asked to me by Greg H. Greg is in our trading room. He's also based in the US. He was asking about when the T2 isn't setting up because of the longer slow stochastic is in between 80 and there's no clear T10, what's the next best thing to do? Switch to a smaller tick bar? Well, Greg, you can actually do that, but sometimes not having a signal is good, just to sit back and wait. And that really gets back to something that's very hard for us as traders, to sit and wait for the trade to come to us. We're born hunters, and we want to go out there and look for the trade or chase the trade, and that's where sometimes just laying in wait and waiting for your prey. So sometimes if we don't have a trade, we don't have a trade. We just got to sit it out. Now, not saying we don't drop down to a lower time frame. For an example, there are quiet times even on the CL where you may drop down from a 233 down to a 144, or on the ES you may drop from say a 610 or a 550 tick down to a lower time frame. You can do that by all means, but just be aware that quite often when you're in quiet times or in a very quiet market, you also may be in a trading range, and that's where you want to be very cautious. So if you're trading say something like CL, there's basically a trade as we know, every 5 to 10 minutes. So we just want to be very cautious and really sit back there and wait for the trades. So Greg, hopefully that that answers your question. It may or may not, but hopefully it does. Now, by the way, Jesse Livermore, most of you know, Jesse committed suicide at the age of 63. He blew his brains out in a bathroom, in a toilet stall. And as he said, when he lost his fortune, he was worth $100 million back in the 20s. And as he said at one stage there, and he took responsibility, and he said basically the mistakes I made were all mine in the end. Now, theory is, by the way, he may have suffered from bipolar and had or a serious mental condition that was never actually treated, and that's what really fanned his losses and his, in the end, him taking his life. Well, of course we'll never know, but there's also wisdom in what he says. Next thing I want to talk about is scalping, and this comes up regularly, and even in the trading room it's come up a great deal, and I've had a lot of emails, and I receive emails about letting your trades run, getting in and getting out. So as an example, traders, if you're scalping the market, say if you're let me once again, just for the sake of the exercise, use CL, because you can scalp at least in a 4-hour trading period. You will get 20 scalps if you're taking, say, some trend trades, some counter trends, some T89s, some T3s, etc. Your 34Bs, your look, there are 20 scalps a day there. Now if you're scalping 5 ticks, okay, so let's just say you scalp 20 trades in a day and you are right 80% of the time, you can have a stop of 10 ticks, that is to have 4 losing trades at 10 ticks and have 16 winners at 5. And after, let me just round this up, and after paying $100 in commission, say $5 each in commissions, you're still netting $300 per contract. Now if you're only taking 10 trades a day, you're only netting $150 per contract. But hey, you can become very wealthy over time with only scalping 10 trades a day. Now if you then all of a sudden are trading 2 contracts and you're letting your second trade run, and you're getting a 70% win rate at 10 contracts, at 10 ticks, okay, that has a very, very nice boost to your bottom line. And I think mathematically, if I remember correctly, it brings you up, if you're allowing once again a 10 tick stop, a 10 tick loss, winning 70%, so that is 1 contract off at 5 ticks, your second one running to 10, 80% winners on your first, 70% winners on your second, you're netting around $700 per contract. No, my apologies, it's $500 per contract. So you know, and that's by 2 contracts, so it's $1,000 a day. So you're making very, very good money. Now, by the way, if you go for 6 ticks on your first, you're netting $580 per contract. Now sit down and do your math on that yourself. So I know all these figures, you're going, oh gee, I can't keep up with you, Ray. Okay, so just spend some time and look at that. So there's a lot of scalpers, so you can scalp the market very successfully as long as you're good with the finger, you know how to use your dome, and that's the other thing too. I'm going to have John do a recording this week on bracket orders and on OCO orders, etc., because I think a lot of traders are a little lost on placing orders, how to get in, how to get out, putting the stop losses in, etc. That's very, very important, particularly with CL. As we know, it's a bit of a wild animal and it can take off very, very quickly. So another question here from Terry was about brokers. Now the US-based brokers on futures, there's TradeStation, NinjaTrader, and AMPS. They're really 3 of the best. With TradeStation, you need to open your account with a minimum of $5,000 US. I'm not sure what the amounts are with NinjaTrader, or it's a lot less with AMPS. Of course, if you run with TradeStation and trade on the same platform, it just makes it easier in many ways. But AMPS are one of the best brokers as far as commissions go. Of course, you can go with Interactive Brokers as well. They're excellent. I think now they're the largest futures broker in the US now. All of them are regulated, and under the new regulations, the CFTC, I'm pretty certain the CFTC, or is it, no, I think it's the NFA. The NFA now have logins where they can log in and check a broker's balances in their account at any time. Okay, and you may remember, of course, a couple of years ago when PFG fell over, that was when the owner of PFG went and tried to cap himself, commit suicide. It's because on the Monday he had to actually was doctoring the account balance, the account statements from his bank, which he had to send through to his account, which then were sent into the regulators. They then brought out a new regulation that they had to be able to log in and check your bank accounts to verify that none of the documents or none of your bank statements were being doctored, and that was really the beginning of the end for PFG. And of course then a few days later he tried to commit suicide. And for many of you who weren't aware of the story, for many years the owner of PFG, he'd been doctoring, his bank statements would go directly to his PO box, post office box. He'd get them out and he'd doctor them when they had I think it was under $10 million at the time in their the company bank account, and they were meant to have at the time, I think it was meant to be about 130 million. So they've built new offices, they've been living a great lifestyle, but anyway, the point, long story to this point here, is that the regulators have really come down on the US brokers in so many ways. So going with a US broker, I can't quote you about or tell you anything really about the UK brokers, but the US brokers now, the regulators are really coming down, and they're going to come down even more after what's just happened with FXCM. Now another question is about some UK brokers, and where you can get split pips, or rather than paying $10 on CL, sorry, at $10 per pip, you can get it down to $5. Traders, please beware. There are some brokers in the UK where you can actually trade futures contracts with a spread. But if you check out the spread, last time I checked, if it's $5 per tick on CL, the spread worked out to be about 3 ticks, which was $15. Or if you were trading a standard lot, it works out to be $30. Traders, please don't pay spreads on trading futures contracts unless you've checked it out and it's well under $4.50 round turn for a standard lot. So or a standard contract. So just be very aware of that. So with brokers in the US, just to finalize that and move on, AMPS, NinjaTrader, TradeStation. By the way, I'm a broker neutral. I don't receive any commissions or anything like that, but just spend some time and look at that very closely. Now let's go into this. Now I released a video last week, or a few recordings, where I'm talking about bull and bear patterns, and let me just clarify a couple of things. I've spoken in the past that even my own setups for T1, the T2, a lot of our setups are based really on bull or bear flag patterns, and I've got this one from somewhere, this little diagram, just doctored it slightly here. But if you look at it, like here we've got this is almost a T25, a 2 to 5 candle pullback. We had a close above V8 and a trend continue, and in we go. Now bull and bear patterns are trend continuation patterns, so just be aware that bull and bear patterns are not really designed for range bound markets. They're trend continuation, so they work best when the institutions are buying or in high volume periods, and not for consolidation zones, etc. With that being said, when I recommend something to do, and as an early heads up to a T1, a T2, T25, and many of our other setups, if you draw in your little trend lines as you start to get a retracement or a pullback, just be aware that sometimes you'll get one candle pop up, and where I've said in a video last week, buy on the break, well, just remember, one may pop up, then it falls back down and then continues down. Now that is one of the advantages of, say, a 34B or some of the deeper pullbacks. The deeper pullbacks will usually be slightly more reliable on your bull and bear patterns. And natural fact, technically speaking, to have a bull or bear flag pattern, the pullback minimum is 3 candles or bars. So I once read many years ago, but something I just want you to think about there. Now leading into this is something that a lot of debate recently we've had about, and I'll get to more of this in a moment, a paper that I posted on the website, and I've mailed out directly to our room members by Patient Trader, that he sent me. I spoke to him on Skype yesterday, and you know, look, we've got some outstanding members traders and some very experienced and some real wisdom. And so we'll come to his paper in a moment, but please remember, on my Google Drive and very soon the website, we haven't moved everything over yet, but it's happening. So on my Google Drive, there's a folder there called 34Bs, and you'll see a lot of this information in there. And thanks to Rick and a few others put this together for us last year. A lot of really good back-tested results, etc. And the 34Bs are a very reliable trade. So I want you to go and have a look at that. Have a look at the folder when it gets to, sorry, I've just got a bit of noise in the background. So the 34B, sorry, back to that. 34B is an excellent trade strategy. So I just want to remind you, there's a great folder on the Google Drive where we discuss the 34B. And talking to Patient Trader, he just sent this through to me yesterday, and we had a great conversation. And this leads me then into a little paper he put together. And that's one thing with a lot of our members. I won't read it all out here, but it's on my Google Drive. So it was uploaded on the 10th of February 2017. And it's just really talking about, and it's headed up Confused, and this talks about, and I talk about this regularly. The amount of setups that we've got is to become very, very good at just a very limited number of setups, and go from one, so master one, become the specialist, and go to the next one, etc. And the 34B is just one of those brilliant setups. Okay, you've got a decent pullback. Now, just while I'm on this, we can see here we've got basically a 34B here, we've got a 34B here, we've got a 34B here. Okay, and what are these also? These are flags. So see, you've got a trend line there. You can then draw in a parallel line, and these are basically flags. So there's a flag there. You could have, this is not quite, I like to see more of a steeper pullback, but you can still trade the break here. You've got another flag there, you've got one here. So these are flags, but they're trend following. Okay, and you've even got sort of one up here. Now I can't see much of a history there, but you basically got one there as well. So drawing these trend lines in at the base of these can be an early heads up of a potential trade setup or a potential short, something I'd like to recommend you have a look at. This now leads me into a couple of questions here by Roman, and I just wanted to just quickly go through here about some of these shots. Okay, attached a screenshot on the last trade, which was a loser. Would you please address it in the next session? Would you have entered this trade, or would you stay away? In either case, why? I see there's divergence, but would you consider this divergence in making a decision on whether to stay away from a trade or not? Very, very good question. Okay, so looking over here, you can see here, this actually is a T3. Just to correct you on a couple of these this labeling here. So the reason this is a T3, notice how price is gapped away. A T9 is when price action comes down, we get a kick up, and I get a white paint bar, a super scalper paint bar plots. Okay, that is what I call a T9, or it's very closely related to a T10. So where you get price action moving away like this, that's what I call a T3, and you don't necessarily have to have divergence. A T9 is where the market then comes down, you get another pullback, sufficient enough that you get a white paint bar. Okay, and this could have even been a T9, comes down, pulls up, and then we're in. Now this is a T25. This actually could be one of two trades, and this is where sometimes you'll have our trades will amalgamate, or if you like, get two different types of trades firing off at the same time. Is that you've had a T25 up here. Notice your 8's crossed through your 34. You could have entered in here and shorted the market, or your T20-1 is where you have the market come down, you get a pullback, and it's your first trade. It can be any type of trade after you have a T20. So that is effectively a T20. It's the first trade. -1 is the first trade after. So that there, if we had a stochastic down there, that could have been almost a T2. It probably wasn't a T10 just because it's fairly extended move before you had that, but yes, it is a T25, and it could have been a T2 as well. Okay, now this trade up here, this is our classic, what is this? This is our classic 34B, and it actually happens to bounce on the 89 as well. Now remember, when you get an 89 bounce, a logical target area is your closest swing low or swing high, but in this particular case it's more of a 34B, but you get combination bounces at the same time, and away we go. So that should have been a trade entry, but I see here you're already in this position anyway. So of course, if you're trading one contract, you don't have the funds, you're not going to enter. But this is a classic case, by the way, traders, where I mentioned if on a 5.5% risk I would enter another trade. So I still may have been in this trade. I would then go and sell another contract here because it's still within well within my 2% rule. So as a T9, no, this is not a T9. This once again may have been a T3, but without looking at the anchor chart, this is not a really big mean reversion pullback. So you're getting some slight divergence here. We've got a bounce here on a longer term EMA, I take it here. So it's actually not a T9. It's it's probably more of a T19, more of a divergence trade. We can see we've got some divergence down here. We then come up here. It'd be interesting to look at our anchor chart to see what we've bounced this is, and I'm not quite sure what these dotted lines are here, but you can see here you've got a bounce, and this may have very well been a trade entry. Up here, this is a T9 up here where you can see it's got a lower low. Now when you start to see this, why I like T9s is simply it's a deep enough pullback to then have the T1 plot. So you'll quite often see me drawing a line from that point to that point, and in we go. So that is a T9. So what will we do up here? Yes, we have divergence setting up here. Okay, so you do have a divergence trade. So a couple of things you want to look at is the further away from your EMAs you have a trade entry, the more likely you are to have a pullback. So a couple of things are happening here. One, we're getting angulation. Notice how the 8 EMA is very clearly fanning away from the 34. So we're getting angulation, price actions moving away. So without seeing it live, because once again hindsight is a wonderful thing and very easy to look back, it's unlikely I would have taken that trade because of a distance and the angle I'm moving away. Now on top of that, if we look at the timing there, okay, well, that's all within a 6 minute. Look, I can't really categorically say I wouldn't have, but I don't think I would have because of the distance I'm getting, but I would have had to have seen, because if we look at the time, that's all within a couple of minutes, and that's at 9 a.m. so that's another thing here. Okay, it's a 2:33, so I'd need to see the speed of the market. Now traders, if the market is moving too quickly, and this is a CL chart, do you know what I do? I sit it out. Okay, I prefer to lose a trade, and that's very important. You always check in doing your time, your back testing, always check the timestamp on the bottom, because if that's moving too quickly, I would not jump in, because I tend to find I'd have to use a market order. I'd probably get a couple of ticks slippage, and I'm going to be too late into that entry. But what we do have here is a classic divergence trade. So if we had have missed that, we do have a classic divergence. Okay, so we can see here that we've got a lower low on my platinum here. You'll see me mark these up on a regular basis. One thing I want to mention here, which comes up time and time again, and please write this down if you have the Super Scalper and TradeStation, NinjaTrader, or if you're using or you understand how the pattern works. One of the things you can do here is use the T1 for your exit as well. So see if we got in here on this divergence trade, where is an exit? Well, say if you're trading 2 contracts, on your first contract you may scalp the market for 5 or 6 ticks, as we've spoken about earlier. On the second one, you could trail up until you got either a close under the 8 EMA up here, or you get a counter trend T1 plot. Okay, so that would have left you in all the way up there. Even down here, you've shorted the market here, and you would have been in all the way down to here. So you can actually trade T1 to T1, T1 to T1. Now sometimes it will give back too much, like this one here. You wouldn't have plotted here, and of course if you had have gone long here, where is your logical bounce point? Your 34, and of course your 289. So a lot of resistance there, so you want to be cautious on these. So the further away from the EMAs, the more wriggle room you have, and particularly when you have divergence. There's no real divergence there. You've got what I call a flat bottom. There's no divergence. So if I'd have entered here, you could have actually exited. When's my next T1 going to plot? Now, of course, T1s aren't perfect. That is, sometimes you can get 3 or 4 T1s, say, to go short in a row. So you're not always going to have sell, buy, sell, buy, sell, buy, sell. Okay, you'll sometimes get 2 or 3. You may have actually, and even there, 1, 2. Look, you may have even got there if this was set up later on. So just be aware of that. But you can use your T1s for your exits. Next thing is I posted on Friday, I think it was, or on Thursday, the 9th of a second actually, a little one there on day trading CL tips, and I've posted a few in the last week or so, and I've spoken about drawing flags in. So I'd like to really recommend that you have a look at those just on drawing flags. Even though I'm talking about CL for our CL members, it's just as applicable and works brilliantly on ES, on YM, on Forex, on any market. It works really well, so just be aware of that. So even though I'm talking about CL there, if they work on any market. So traders, you know, if you're into mastery, repetition is the master of skill. Sorry, is the mother of skill, I should have said. So let me say that again off the top of my head. Got to remember all these statements as I go. As you know, these are always unscripted, these sessions, but if you're into mastery, repetition is the mother of skill. And getting back to what Patient Trader had to say is, and you hear me say this many times as well, and it's good for you to hear someone else say it, become a master. Who earns the big bucks? The specialist. If you've got to sit back for 2 hours and just wait, okay, just wait. You know, it's a skill you need to develop and work on. Really work on that, because our game is really about patience, discipline. Okay, got to remember that. So traders, we're now 36 minutes in. I'll wrap this one up. So hopefully I've covered all the questions. I'm just quickly looking here. Okay, on you know, sometimes we don't get trades, Greg. Well, just sit it out, buddy. You get T25s, you get others. Yes, you can drop down to a lower time frame if it's extremely slow. Now, by the way, traders, is that if it is slow, really slow on your normal time frame, just go and check to make sure that you don't have any news announcements. And of course, checking for news should be the first thing you do every day. Write it down on your trading journal at the top of your where you're taking your notes every day if you've got a news release, as a reminder. Now remember one more thing: in developing discipline's like a muscle. The more often you do it, the better you become at it. Thank you, traders. I'll see you on the next Q&A session.